Even with recent market uncertainty and turbulence, there are still opportunities to be had in this market. I wanted to review the top 5 stocks to buy right now, starting with Google. I released my Google stock analysis video on March 12th. Since then, this stock has been up 5%. I highlighted how Google is trading at a discount from a financial ratio perspective, that search is still growing even with the increased fears, and that Google is more than just a search company. They are a leading AI company. Check out the video in the top right. Google stock has been trading at a discount because of market fear of a paradigm shift, that AI and LLMs are going to destroy Google's search business, which makes up 56% of Google's revenue. But investors cannot forget that Google is a money making machine with revenue streams from other fast growing sectors like Google Cloud, YouTube, and other side bets like Waymo, their driverless taxis. Google Cloud revenue is up 203% since 2021, YouTube ad revenue up 49%, and Google Search, even when the market and media is saying search is dead, continues to grow 59% since 2021. Google traffic continues to remain strong and has grown 37% in the past 6 months. ChatGPT.com is also growing at 30%, but Google is already established and Google traffic is in the billions. It's harder to grow 30% in terms of billions compared to millions for ChatGPT. Netflix is roughly the same size as Google's YouTube from a revenue standpoint. Netflix generated 10 billion in quarter 1 2025 compared to YouTube's 9 billion. And Netflix has a market cap of 400 billion. Oracle has similar revenue compared to Google Cloud, and Oracle's market cap is 421 billion. If we assume Netflix and Oracle's market cap to these Google segments, and let's say we assume 10% of Google's market cap to their subscription, devices, and other bets segments, that leaves us with only 883 billion in market cap for Google Search. But Google Search makes nearly 5 times more in revenue compared to Oracle and Netflix. But this 883 billion market cap on Google Search is only worth twice as much as Netflix or twice as much as Oracle. And I think this valuation is too low. Also, Waymo is a small bet Google has on the side, and they have robotaxis on the road as we speak. When Tesla talks about robotaxis, the stock goes up billions of dollars in market cap, but Tesla is only finally entering the robotaxi market, while Google's Waymo has already been fulfilling rides in San Francisco, Phoenix, and Los Angeles. Waymo is also coming to Tokyo, making Waymo international. So, times like these are when the market seems to be a little silly. Google does not get credit for having robotaxis on the road, but Tesla gets all the credit so far as long as they talk about it. Historically, Google is trading at a discounted price to free cash flow and price to sales ratio, potentially indicating that Google is at a decent entry point at these prices, especially for long term investors. I can see Google going to 200 and then some as sentiment around this stock improves over time. Amazon has been increasing capital expenditures for AWS to continue to benefit from the strong AI boom and robots for their warehouses for automation. These big expenses can cause short term pain for the stock price because the free cash flow is suppressed, leading to high multiples. Investors get wary when companies start to spend tons of money on expenditures that have no guarantee of working out. However, I think there is plenty of potential for Amazon with these endeavors. If we look at history, Amazon's free cash flow went into the negative in 2021 and 2022, 14 billion and 16 billion full year respectively. Makes investors weary. High costs make the company look less efficient, even though they were being ahead of the curve, and the stock price was not recognized for this endeavor until only after the fact. So, what was Amazon doing in 2021 and 2022? They were investing heavily in their fulfillment centers because of rising e commerce demand during and after the pandemic. Amazon reduced their dependency on FedEx and UPS by upgrading their logistics network as well. Amazon was also building data centers for AWS to meet growing cloud demand. But during the full year of 2022, Amazon stock was down 51%, while the company was making these heavy investments. Thanks to these investments, though, Amazon customers have a better shopping experience. More fulfillment centers mean faster deliveries. Less reliant on vendor shipping can bring shipping costs down. AWS is capable of handling more cloud demand, taking market share from Google and Microsoft. So now we're in 2025, and Amazon is doing the same thing, investing in infrastructure for the company's future. I would rather have a short term suppression in stock price than a stock that makes huge free cash flow but no plans for growth in the future. So, what is Amazon spending its money for now? Expanding the AI capabilities of AWS and increasing cost efficiency through automation and robots. My Lyft analysis video explained how Lyft was trading at a discount compared to popular competitors like Uber, DoorDash, and Instacart. I also mentioned how their fundamentals are growing while the stock price continues to go down. This divergence between stock price and fundamentals supported an asymmetric risk to the upside because Lyft was already valued so low. It was only a matter of time until the market starts to realize that there is opportunity for Lyft. I still see growth with this company as it captures market share, going international with the Free Now acquisition, getting their foot into the door with Europe, a leading multi mobility app for taxi offerings. As we get through the AI market, many people know NVIDIA, the company selling the chips, but let's talk about the stock that helps create the chips, and that would be ASML. We want strong companies in our portfolio that have reliable revenue and barriers to entry, meaning no other company can easily take their market share on a whim. These features can make up a good company, and these are found in ASML, a monopoly in chip manufacturing because ASML is the only company in the world that produces extreme ultraviolet lithography machines, the most advanced type used for making cutting edge chips like the 3 nanometer and below. EUV machines cost 150 million each. Companies like TSML, Samsung, and Intel rely on ASML's EUV machines for advanced chip making. ASML is considered a choke point in that semiconductor supply chain. I placed Celsius stock near the bottom of my list because Celsius is nearing my price target from my original video. I released December 10th, 2024, when the stock was only $30 per share. We're now up 28% since this video. In the video, I discussed how Celsius's valuation and how mean reversion told us the sell off in the stock may be overdone and was due for a rebound. Celsius has been growing strong as they acquired Alani Nutrition for 1.8 billion. This stock has been great for selling covered calls against for passive income. Check out my video on AI option predictor in the top right. Hope you enjoyed my list for the top 5 stocks to buy. Intrendias is not financial advice, but I hope you found the video informative. Consider clicking subscribe and thank you for watching, and I will see you all in the next one.